Hello and welcome to United Asset Strategies' third quarter client webcast. Today's October 11th, and this is Lee DiLorenzo, President of United Asset Strategies. Joining me today is Tom Healy, who's listed below as an equity strategist, but he is the architect of our Value Plus model and our recently launched ESG model. ESG stands for Environmental, Social, and Governance. More and more, our clients have been seeking a way to invest with their conscience while having a tactical allocation, and now we can help. And I would like to discuss the past quarter and what we are looking at during the next quarter. And by taking a look back, we can gain some perspective on the market's gyrations, which have been picking up over the last few days. Last quarter, the returns across major assets were quite mixed, up 7.2% for U.S. stocks, to negative 2.4% for municipal bonds. And for the year, the disparity is even greater. A closer look shows the returns of the U.S. stock market have been hugely concentrated in a few sectors, namely technology, consumer discretionary, and healthcare. And surprisingly, more than 50% of industry sectors within the S&P 500 are actually down through September 30th. And now, through yesterday, October alone, the S&P has fallen more than 4%. With such wide disparity among asset classes and sectors, I believe that clients benefit from United Assets' active approach to equity and fixed income management because we're attempting to add value by trimming weak sectors, adding to those with strong outlooks, and others offering deep value. Another observation for the quarter was the continued rise in short and intermediate interest rates. Our chart illustrates the yield of the 10-year Treasury bond, which exceeded 3.25% just a few days ago. Given the levels and our outlook for inflation, we purchased U.S. Treasury inflation protection bonds, also known as TIPS, during the quarter. Rising rates are seen as a headwind to the economy, and with the Federal Reserve signaling their intention to continue raising short interest rates over the coming months and years, this is something that we're looking closely at. Now, many observers have been worried about the yield curve inverting. This phenomenon occurs when shorter-term bonds pay more than longer-term bonds. This chart indicates the spread between the 10-year and 2-year bond, and you can see has come very close to inverting. An inverted yield curve has been associated with recessions. It's not the only indicator by far, but it bears watching. And if you look closely at this chart, you can see a very small recent turn-up, which has continued nicely to increase over the last few days. It seems for now an inversion has definitely been averted. I would now turn the mic over to Tom Healy so he can address what we are keeping our eyes on for the next quarter.
Thank you, Lee. As we look to the fourth quarter, there are a few things that we're watching. The first thing is the U.S. economy. And as you can see on slide 7, the U.S. economy remains broadly strong. The first chart shows you the U.S. PMI, the Purchasing Managers Index. That's a very good indicator of the health of both the manufacturing and the service sectors. And as you can see from the chart, it's near cycle highs. We also look to the right, that's the U.S. unemployment rate. The labor market's been very strong, and right now it's about 3.7%, which is at a multi-decade low. Other things we're looking at, like confidence surveys, consumer confidence, small business index, optimism, all point to very strong, broad-based strength in the economy. In fact, if we look on page 8 of the slide deck, you can see that the U.S. is leading global growth. Now, this is the IMF forecast for the G7 economies, and as you can see, the U.S. bar on the left is the strongest. Year to date, economists have raised their forecast for U.S. GDP by 26%, and it's closing on 3% GDP growth. That's outdistancing all the European countries and nearly double what Japan is supposed to grow this year. And if you look at the trends, as I mentioned, the U.S. trend is up, where the European economies, the trends are down. So now we're seeing the U.S. strength plus tax reform translating into what is expected to be a very strong third quarter earnings report. On slide 9, we break out for you what we expect to see in third quarter earnings when they're reported over the next few weeks. Starting at the bottom, revenue growth is expected to be about 7.4%, driven by the strong U.S. economy. Adding margin growth, a 7.5% benefit from taxes, and then buybacks with companies that are flush with cash, you end up with projected EPS around 20% in the third quarter. Over the last several quarters, companies have been able to beat expectations by about 3.7%. So when you factor that in, for the third quarter, earnings are expected to be close to 25% when all is said and done. And that's pretty close to what we experienced in the second quarter. Investors are watching this closely because earnings period tends to be more volatile. Another issue that's going to occur during this period is the midterm. And so turning to slide 10, we want to give you our assessment of the midterm election. The first chart shows us what happens in the first term of a president's midterm election. And generally speaking, that president loses about 29 seats in the House. There's generally an anti-incumbent bias, and there's more enthusiasm for the anti-incumbent party going into this election. That number is important because right now the Republicans have a 23-seat majority. So if things happen like they have historically, they would lose control of the House. Turning to chart 11, this is the latest polling data in the House of Representatives. What we're seeing here is Democrats right now, there's about 205 seats that are likely or leaning Democratic, 198 leaning or likely Republican, and 32 that are toss-ups. The key number on the bottom, as I noted, is 218 seats are needed for the majority. So basically, the Democrats just need to capture about 14 of the toss-ups in order to gain the House. And a couple of things that we look to try to predict the outcome are the generic ballot, the presidential approval rating, and also the enthusiasm gap. And all those things have been very much in favor of the Democrats, and we've seen in the recent special elections have considerably been stronger for Democrats. Looking at chart number 12, this is an analytical comparison of the election. So what we're seeing here for the House, there's about a 75% likelihood that Democrats take over the House. It's estimating right now that they would gain about 33 seats and therefore the majority, and about a 25% likelihood that the Republicans keep the House. While the Democrats have all the momentum in the House, the Senate's a different story, and that's because of the map. The map really favors the Republicans. There's 35 seats up for election, of which 23 are Democratic, and of those 23, 10 are in states that were won by President Trump. So it's an uphill battle for the Democrats. Republicans have a 51-49 majority right now, and based on the current polling, there are 44 leaning or likely Democrats and 49 leaning or likely Republicans. And recent gains have actually gone the Republican way. In North Dakota and in Texas, those both moved from toss-up into the Republican zone. So the Republicans really just need to win one of the remaining 7 toss-ups to keep control of the Senate, and that seems very likely. In fact, a similar analysis from the Senate shows about a 20% or 21% likelihood that the Democrats take the Senate, and a 78% likelihood that Republicans maintain control. In fact, the odds are basically flipped, that the Republicans are likely to about a 75% chance of keeping the Senate and a 75% chance of losing the House. And that's how we see things going here. But there's good news here. No matter what the outcome, equity markets historically have been up no matter how partisan control is shown. And we see this on page 15. The red bar on the left shows that the best performing equity market historically has been when you have a Republican Congress and a Republican president. And that bore itself out in 2017 when the market was up 19.4%. The red circles are around the 2 likely outcomes of this election, which are a split Congress and a Republican president, or a Democratic Congress and a Republican president. While the outcome for the equity markets favor a split Congress, either way, equity markets tend to perform positively no matter how the politics are constructed in Washington. And so these are the things we're watching, and with that, I would turn it back to Lee.
Even though this broadcast is designed to discuss the third quarter and our outlook for the fourth quarter, because the market has turned down so abruptly and is volatile as it has not been for the past 8 months, I think it would be remiss if we finish this recording without addressing it. I would like to say that, market sell-offs cause discomfort. And there's certain charts that we look at that actually will show that we were in a period of extreme greed or greed And now we're moving into fear and into extreme fear. Almost every time that we move into extreme fear and can stay there, buying opportunities actually present themselves. So depending on which strategy you're investing with United Asset Strategies, please know that we are here to take your phone calls, respond to your emails. It's just part of our stewardship campaign for you is to address your changing risk tolerances in different markets. I want to thank you all for listening in and encourage you to give us a call to address your questions and to work on your tax planning for the last quarter of the year. Thank you.